Hello, Friday. World news. Start in America with the Empire, New York Fed, general business conditions. It was out yesterday, and here it is, and it's the same old boring shape. Down to 2008, see it along the bottom, all the way down, and then all the way back up again. V-shaped recovery. Along a bit, and the latest one has turned all the way down. Normal. Okay, in the guts of this was this general business conditions. These are split in half. The dotted line to the right of the dotted line is this year, 2011. As you can see, this year has been quite reasonable at plus 20, and it's just dived down, the top one. New orders have been going up, if anything, but now going down below zero. Shipments up and down, but certainly this latest one down. And in the guts as well is this one, 1C, prices paid and prices received. You can see all the way through 2011 going up, and this last one ticked down due to oil and other things going down. But this is prices received, profits as well, going down. Right, this is quite interesting, this. From Alphaville, Financial Times, what modern oil market intervention looks like or not. Is this the reason why the rest of OPEC were miffed at Saudi Arabia last week? The answer, I don't think, is no. Reuters reports on Wednesday, and this is really weird. Exclusive. Saudi, US discussed proposal to swap light SPR crude for Saudi oil ahead of OPEC's meeting, said sources. The idea was that to get the price down of WTI, the US government sells the petrol reserve off, which is light sweet crude, and Saudi would replenish it with their heavy shit. And nothing came of it, but there's been the whole differential between West Texas Intermediate and Brent, and there's something very weird going on with all the pricing and moving of oil around, that something similar to that looks like it's happened, but it might not have been exactly that. But what a wild idea, eh? Right, moving on to the Telegraph, talking about the world. Philip Aldrich, who has been known to write sense, gives us these 4 paragraphs. Britain's relative resilience emerged in the closely watched leading indicators index compiled by the OECD, which suggested major economies across the world are losing growth momentum. Only the United States is showing clear signs of expansion. So if the United States is good, we're in deep shit. As even fast-growing emerging economies come off the boil, both the UK and Germany are holding steady. So America's pushing on ahead, UK and Germany are holding steady, and others are falling back. That's very bad, isn't it? The OECD's monthly update for April pointed to a mild loss of growth momentum in most major economies. A notable exception is the United States, which continues expanding relative to trend. The indicators point to a stable pace of expansion in Germany and the United Kingdom. China, India, Russia and Brazil, the BRICS, are all facing a loss of growth momentum or an outright reduction in the rate of growth, raising concerns about the resilience of the global rebound. Emerging markets have got to sell their shit to somebody, and if we ain't buying it, nobody's buying it. I've put this Ireland one in first before we go to Europe. Ireland revives haircut demand. The Irish government has revived a demand that some senior bondholders be required to take losses to lessen the cost of Ireland's bank rescue. This is just not the... Well, they've got to do it sometime, but can you imagine how annoying this is when they're trying to sort Greece out, which it seems insoluble, and Ireland come in and tug on their sleeve and say, we like to we haircut for us as well, to... You go, how welcome is that going to be? Michael Noonan, Irish finance minister, said on Wednesday that Dublin had raised the issue at the highest level, etc., etc. I mean, they're only talking about 3 billion euros, approximately. I mean, really nothing in the whole scheme of things. That's just being annoying for the sake of being annoying, or trying to appease the people in Ireland, saying, look, we're trying at least. But imagine how annoying that is for the people trying to deal with the Greek problem. Speaking of which, FT Alphaville, the humble Greek depositor, and the ECB, as the tear gas swirls in central Athens. Euphorism du jour from S&P, downgrade of Greek lenders. That's the banks. And S&P go with, we observe that domestic customers of Greek banks have demonstrated their sensitivity to signs of deterioration in the sovereign's creditworthiness. In other words, the Greeks know what's going on. They're pulling all the money out of the Greek banks. There's a run on Greek banks. And what can you do when there's run on banks? It's terrifically difficult. And that's what, that's what they're trying to sort out. Right, where do we go next? And this looks like another pull from a Telegraph article. The link below if you want to read more of it. And this is about Europe. I thought that these paragraphs, to some extent, summed up the political shenanigans that are going on. The French want Greece to stick to the terms of its debt repayments, even if it means deeper cuts and asset sales at home. Greece has to sell the Parthenon, etc. They reckon that any form of restructuring will be met by the markets as a default. I'm sure it will. If it's a default, it will be met as a default, with potentially tragic consequences not just for Greece but for Ireland, Portugal, Italy and Spain as well. The ECB, led by Jean-Claude Trichet, has long held the same view. But over in Germany, Wolfgang Schäuble, the German finance minister, recently broke ranks with an open letter arguing that bondholders should share some of the costs of the bailout. He said the bonds should roll over and the maturities of the debt be extended for 7 years. So that's the German idea, that the bondholders should take haircuts. Belgium and Spain recoiled at the German suggestion and sided with France and the ECB. It's a hell of a fight going on. They're just looking for the easy way out, and there isn't one. Don't worry, we're not going to read all this. This is from the Office of National Statistics, the UK. Yesterday's retail sales for the UK were out, and this is for predominantly food stores. Supermarkets, I imagine, that sort of thing. Year-on-year change and seasonally adjusted. It goes back just over a year, this chart. I've done the yellow in, which is the zero line. The dark blue is volume, and you can see up till the royal wedding, when everybody ran out and bought a new hat, for a year it had been below zero. In other words, negative in volume. And that last little kick down for this release, which was yesterday's release, an awful big kick down into negative territory in volume. The light blue one that is above the line is what they call value, I call price. And the difference between the two you could call inflation. You're paying a lot more all through the year over last year's. More is being paid, but the actual volume is less. In other words, they're selling less, but you've got to pay more for it. That sort of idea anyway. But it's the volume really we have to look at, and it's negatory. Right. Oh yes, we're going to finish with this, which is the Financial Times' Chris Giles, big brain there. Are tax increases and public spending cuts wrecking the recovery? This is the government and its austerity measures, and the whole thing is keep the faith. Plan B is not the answer. In other words, keep right on till the end of the road. Right. It's a reasonable long article. I've pulled this from the middle of it. In a world where fiscal consolidation is savaging demand, you would expect to see a spike in unemployment. inflationary pressures falling away, and weakness in tax receipts. And we see none of these in Britain today. Unemployment came out midweek, and it was very good. Lots of people finding jobs in the UK. The next thing was you would expect to see a spike in unemployment, inflationary pressure falling away, in other words, more deflationary pressure or less inflation, and a weakness in tax receipts. In other words, obviously, paying of taxes would go down. We see none of these in Britain today. In other words, the austerity isn't crushing the economy. And when I just see that we see none of this in Britain today, it worries me, because I think I know more than him. And that really does worry me. It bothers me a lot, because I am pretty sure he says we see none of these in Britain today. And I say, quite right, Chris. But you will. You surely will. There will be more unemployment. Inflationary pressure will drop away and it will turn deflationary, and tax receipts will dive. See you at the end of the year and we'll compare notes. Have a good weekend. Bye.